In Chapter 7, we move on to mortgage markets. We're probably all familiar with mortgages from the borrower side. Mortgages are loans to both individuals and businesses to buy real property. Many mortgages are securitized, which means they're pooled and sold. The monthly mortgage payments act as collateral for mortgage-backed securities, MBSs, which we'll look at. Compared to stocks and bonds, mortgages are backed by a specific piece of property. There's no set size, no set denomination, but very little information is publicly available on the borrowers. There are four basic types of mortgages. Home mortgages, the ones we're most familiar with. These can cover anything from a one-family unit up to four-family. Multifamily dwelling mortgages cover townhouses, condos, apartment complexes. Commercial mortgages finance business property. Farm mortgages, pretty obvious. From 1995 to 2016, the share of each type mortgage really hadn't changed very much. Single family, really one to four family dwellings, is still the predominant mortgage category with over 75% of the market. Let's look at some of the terms related to mortgage characteristics. Collateral is the real property covered by the mortgage. The lender places a lien against the property until the loan is paid off. The down payment is the portion of the purchase price the lender requires up front. If the down payment is less than 20%, private mortgage insurance, PMI, is usually required. The Federal Housing Administration and the VA insure mortgages, guaranteeing repayment. Conventional mortgages are probably the ones most of us have. These are not federally insured. Amortized mortgages, and most of our mortgages are amortized, meaning the payment schedule is set such that the loan is fully paid off in a set number of years. Maturities usually range from 15 to 30 years. Balloon payment mortgages are basically interest-only loans for 3 to 5 years, at which time the full principal is due. These are risky for home buyers. Normally, they'll have to be refinanced, and the homeowner will not know the refinancing interest rate until the balloon is due. Home prices may have fallen, which could make it harder to refinance. Employment or health situations could have changed, make it more difficult. Balloon payment mortgages offer lower interest rates, but they're risky, and they're usually used to encourage the home buyer to buy more house than they can afford with a standard mortgage. Not a good idea. Fixed-rate mortgages lock in the interest rate at the time the loan is made. Monthly payments are the same over the life of the loan. With a fixed-rate mortgage, the lender assumes the interest rate risk. Adjustable rate mortgages, or ARMs, have become popular, especially with first-time home buyers. The interest rate is tied to some market rate and can rise or fall over the life of the loan. And usually there are safeguards as to how much it can change. With an ARM, the borrower assumes the interest rate risk. Should rates rise significantly, loan defaults can result. The catch with an adjustable rate mortgage is that the rate, and thus the payments, change over the life of the loan. Payments may be fixed for an initial period. They could go down, but they can always go up. In a 5/1 ARM, the payment is fixed for the first 5 years and then adjusts annually. A 3/1 is fixed for the first 3 years. Some ARMs begin adjusting immediately. Changes may be capped. The 5/2/5 cap means the first rate adjustment can be no more than 5%, and after that the maximum change is 2%, and the maximum interest rate increase over the life of the mortgage is 5%. Adjustable rate mortgages are riskier for home buyers. They may make sense if the buyer believes they'll not stay in the home for more than 3 to 5 years, or that they'll be able to sell or refinance at reasonable rates in the future. Discount points, or points, are a fee paid at the time the loan is issued, usually to get a lower interest rate. Each point is 1% of the loan principal. Other fees are listed here on the slide. Application, title search, title insurance, appraisal. Closing fees typically range between 3 to 5 cents of the mortgage amount, but they might be less. With all of the mortgage rate changes over the last few years, there's been a lot of refinancing. Remember in 331 when we talked about bond refunding? Same logic here. If rates drop significantly, it can be worth it to refinance. Basically, the homeowner takes out a new mortgage and pays off the original loan. The decision for a homeowner considering refinancing is the same as that for a corporation considering a refunding. Does the lower rate over the rest of the loan offset the cost of refinancing, closing costs, etc.? General rule of thumb is shown on the slide. If rates are 2% or more lower than your current mortgage rate, refinancing can be worth it. Each mortgage payment has two components, interest and repayment of principal. An amortization schedule tracks this month by month over the life of a loan. Excel is well suited to create an amortization table, and in fact, we create one as an assignment in personal finance. Again, think back to 331. We didn't look too hard at the actual formula for a mortgage, but this is it. Present value is the amount borrowed. R is the mortgage rate. Remember, the rate for a monthly mortgage has to be a monthly rate. And T is the number of periods, the number of months. To find the payment, we can rearrange the formula to solve for payment, and the calculator solution's on the next slide. Here's example 7.1. Mortgage size, $200,000. Term rate, 30 years, 360 months. The rate is 5.75% annually, which equates to 0.4792% per month. Solving the equation, we get a payment of $1,167.15 per month. Calculator, same solution. Do not forget to make N and IY monthly since you're solving for a monthly payment. Here's the amortization table for the first 24 months. Once you get the first line set up in Excel, you can copy down to create the whole table. We found the payment amount on the previous slide. Interest is the beginning balance times the monthly rate. The amount of the payment applied to the loan principal is the full payment minus the interest. The ending balance equals the beginning balance minus the amount applied to principal. So the ending balance becomes the beginning balance for the next period, and so on. Note that as the payments are made, the percent applied to the principal goes up, while the percentage going to interest declines. And here are the last 25 payments. Continue to note the changing percentages of interest and principal. Of particular note, the total interest paid is greater than the total principal amount. In other words, you paid more than double. Two other types of mortgages. Jumbo mortgages are those that exceed what are termed conforming limits. These limits are set by Fannie Mae and Freddie Mac. Subprime mortgages are those for which the borrower does not meet prime credit rating numbers. Either they have a low credit score or insufficient credit history. Subprime originations were about 9% of the total between 1996 and 2004. They increased to 21% in the 2004 to 2006 time period. Originators weakened their credit standards and quickly sold the mortgages. Alt-A mortgages are riskier than prime, but not quite to subprime. They may represent borrowers who have incomplete documentation, poorer credit scores, higher loan-to-value. The rate's usually somewhere between prime and subprime. Continuing with other types of mortgages. Option arms, or pick and pay, or pay option, give the home buyer the choice of payment options. These are usually 15 to 30-year fully amortizing loans. The minimum payment may be 1% for 12 months. Then the rate grows and the loan balance increases. When the loan balance reaches 110 to 115% of the original balance, the borrower loses the option and has to choose another one. The interest-only payment option allows the buyer to pay interest only for the first 5 to 10 years, but the rate adjusts year to year. Payments will increase when this option expires. Before the crisis, these options were sold to naive borrowers, but they're obviously very risky. The borrowers were apparently told they were not risky, or the risk was downplayed, because the home buyers were told they could refinance when the payments increased. Financial crisis eliminated that ability. Second mortgages, or home equity loans, were designed to allow homeowners to tap the equity in their home, presumably for improvements to the home. In truth, the funds can be used for anything: pay down credit card debt, buy a car, whatever. These loans are subordinated to the original or senior mortgage. The key point is that your home is the collateral on a home equity loan. Reverse annuity mortgages are also called REMs, reverse equity mortgages, a term that is more accurate. Payouts can be lump sum or annuities for a set term or while the homeowner remains in the house. One can also use them to set up a credit line. Probably only a reasonable choice if the homeowner has no other means of supplementing their monthly income and has no heirs to consider. Financial intermediaries have been selling mortgages among themselves for a long time. Small banks especially benefit from this practice. Think about it. A small bank only has so much money to loan. Once it's loaned out, that's it. But if they sell the loans, that brings in more money that can then be loaned. But large banks are more likely to sell off parts of their loans. A financial institution originates a loan and then sells it to a buyer. With recourse means that if the loan goes bad, the buyer can make the originator buy it back. So who sells mortgages? All kinds of banks. Who buys them? Banks, foreign and domestic, insurance companies, pension funds, mutual funds. Think about it. These are collateralized loans. Mortgage sales can definitely be an advantage for the selling institution. It helps them manage their risk and diversify their asset base. Be aware that sold mortgages still generate income to the originating bank, but it can reduce their reserve and capital requirements. Moving to secondary mortgage markets. GSEs, government-sponsored enterprises. Fannie Mae, or the Federal National Mortgage Association, was established in 1938 with the goal to buy mortgages from originators to put money back in the banks to make more loans. Ginnie Mae is the Government National Mortgage Association, and Freddie Mac, the Federal Home Loan Mortgage Corporation. Freddie Mac was split off from Fannie Mae in the 1960s. Two major functions: sponsor mortgage-backed security programs, encourage the expansion of the housing market, especially low-income housing. The maximum mortgage under Ginnie Mae is $484,350 for a single-family home. Ginnie Mae does not securitize loans. They do provide guarantees that allow private entities to create mortgage-backed securities. The four government agencies with mortgage pools supported by Ginnie Mae are the FHA, the VA, Department of Housing and Urban Development's Office of Indian and Public Housing, and the USDA Rural Development. A combination of securitization and congressional push to fund housing for lower-income buyers led to weakening credit standards and an increase in subprime loans. This led to the financial crisis of 2007 and 2008. As the slide says, May 2005 to February 2007, subprime mortgage default rates almost doubled. In 2007, subprime mortgages 60 days or more delinquent rose to over 20%. Problems in the subprime market led to issues in the conventional mortgage market. Home prices declined nationwide. Many homeowners ended up underwater, meaning the homeowners owe more on their mortgage than their house is worth. This provided an incentive for homeowners to default on their mortgages. In September 2008, the Federal Housing Finance Agency placed Fannie Mae and Freddie Mac in government conservatorship. Conservatorship is intended to stabilize troubled institutions with the objective of maintaining normal business operations and restoring financial safety. As a conservator, FHFA has the power of management, boards, and shareholders of Fannie Mae and Freddie Mac. As of April 2011, the taxpayers were out about $132 million on the two mortgage agencies, with more losses expected. The two agencies are involved in about 70% of mortgages. Financial institutions can remove mortgages from their balance sheets in one of two ways: pooling recent mortgages together and selling them in the secondary market, or securitizing the mortgages, which involves issuing securities backed by the mortgages. Securitization has some advantages for the originating lender. They can reduce their risk as well as generate income from the service fees. Mortgage-backed securities. They're somewhat complicated. They allow mortgage issuers to separate the exposure to credit risk from the lending itself. Ginnie Mae, Fannie Mae, and Freddie Mac are involved in the creation of pass-through securities, so named because they pass through principal and interest payments to the investors. Private mortgage pass-throughs are created from non-conforming mortgages. Continuing with mortgage-backed securities. Collateralized mortgage obligations, CMOs, are bonds backed by mortgages. Bondholders invest in tranches or different classes. Each tranche has a different guaranteed coupon. The biggest risk with mortgages are default and prepayment. With CMOs, mortgage prepayments retire one tranche at a time, protecting all the others. Mortgage-backed bonds are yet another vehicle for financial institutions to raise funds without removing the loans from their balance sheets. This is a case where there's no link between the mortgage cash flows and the bond cash flows. The mortgages are merely pledged as collateral. We've covered a variety of mortgage-backed securities, MBSs, pass-through securities, CMOs, MBBs, all with differences but all basically involved with mortgages. These three pie charts show the change in the composition of the mortgage market from 1992 to 2016. Note that mortgage pools have grown to over 50% of the overall market. This table breaks down government-related mortgage pass-through securities by issuer from 1995 to the first quarter of 2016. Every category has grown significantly. Securitization is not just in the United States. Europe is the world's second largest securitization market. The UK is the major mortgage-backed securities issuer, followed by Germany. Securitization in Europe has escalated since the advent of the euro. However, parts of Europe and Asia were not as affected by the mortgage crisis. They did not have the high level of subprime mortgages that we did. Large banks in several European countries did sustain large losses on toxic mortgages, some their own, some U.S. Outside the U.S., originators usually retain title to the mortgages even after securitization. No surprise, securitization has declined since the crisis. The United States accounted for almost 95% of worldwide securitization in 2002. Our share dropped to below 60% by 2008, but came back to almost 80% by 2009. The U.S.'s percent of total market continued to climb, but following 2013, the total market began to decline each year. This ends Chapter 7.